when I look out my window.
Hello traders, Gary Wagner with the Gold Forecast here. It is Thursday, the 19th day of May, approximately 10:45 in Honolulu, Hawaii, and this is the daily report for gold. We have gold trading slightly lower this morning, off about $2, trading at 14.9470, 14.9570. Bid-ask spread, 55 cents apart on each side. We are looking at a daily candlestick chart in which we are looking at our intermediate count. That's this 1, 2, 3, and 4. Our question now becomes, have we concluded wave number 4? Have we entered the final impulse stage? Well, I'm looking at two different studies and two different types of retracements that we've talked about, that classic ABC and the triangle correction. And as you know, when we got that new low the other day, I did negate that as a possibility. However, when looking at this chart in retrospect, I still, and just simply matching up our lows here and our resistance highs here, it is still plausible. It is still plausible that we are still in this type of a corrective pattern. And what I mean by that is, when you consider the following fact, and that is this cycle itself right now has really consolidated. So we have our final leg up, then we have a series of legs. 1, 2, 3, 4. And according to Elliott, we would get our fifth wave down. And then, of course, following that fifth wave, we would then go into what he calls our thrust, and that would be our swing back up. Another way to look at that is by reducing the chart so we can get a more complex view of the market. And I've just done that. This is a 628-minute chart. So we would then take each day and divide it roughly into three components. And as you can see, I have a couple of alternative counts. I'm going to stick with our 1, 2, 3, 4, 5 as a possibility, and then we'll look at the possibility that we have an ABC correction. But when we look at this, we match our highs in terms of our trigger or contact points. We, of course, go from this high here to this high here, and I can actually set that up a little bit better for us. And then on the other side, we go from our lows to our lows, and we'll go ahead and line that up a little bit better, and then go ahead and extend that and extend that, and we get something like this. Now, as you can see, it has absolutely fallen out of line in a couple of places, even up near these highs. And if we get a continuation of this current rally that begun, that would bode towards the conclusion that we're probably witnessing an ABC correction. That ABC correction was in fact a truncated, close to a flat correction. So that what we were looking at in that case was the original concept that we had, which was an ABC having the C wave be a non-traditional C wave, meaning it does not go below the low of 8. The reason I believe so strongly in that as a possibility is that the retracement was so severe when we consider the magnitude in which the market sold off and the timeline in which it did that. Because of that, I felt that it was plausible that we would witness our low on this correction during that initial A wave down. I have most recently published a live commentary, which is now on the Kitco website. I will include a link in today's email, in which we are looking at Henkin candles along with the MACD. I wish to thank one of our subscribers, Mr. Jackson, who had emailed me and said that he found when using the MACD, he found that the cycle of 535.5 pretty much takes the lag out of the market and kind of lines it up. I did some research the other day and find that to be a very fair statement. And the last chart that I want to look at today is our master chart, in which I have converted it to a 628 minute. You notice that I have put support and resistance angles in. I'm starting from the beginning of the actual trend itself, the beginning of that impulse phase. This is when our major 4 ended and the major 5 wave began, our 1, 2, 3, 4. I put that all the way up by matching low, low, and this low here. I then add our resistance from these sets of highs, and with that in mind, I take a look at the possibility again of that pennant or triangle correction. So we get our final move up. We have leg 1, leg 2, leg 3, leg 4, and if this is correct, we will get one small final dip right in here. It shouldn't be too deep, because realize that if it follows along this line, you're still looking at the mid 1480s, if in fact that's what happens. And from there, according to this theory, you would of course get what is called, according to R.N. Elliott, a final thrust, and the thrust would begin the impulse phase or waves, and that of course would consist of a 5-wave pattern consisting of 3 impulse, 1, 3, and 5, 2 corrective, 2 and 4. That, traders, would conclude the end of this phase. We would then go into a corrective phase, and then after the corrective phase, the clock would start all over again. Do I think that the bull market will end at the termination of this major 5? Actually, no. I think we're in a longer term 13-year cycle. I think we've got a couple of years left. For that reason, I think we'll see at least one more full impulse phase. This has been Gary Wagner, wishing you as always good trading, and we will talk to you tomorrow for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange, so strange.